Welcome to Portfolio Casts, the podcast where we break down real investor portfolios using publicly available data.
In this episode, we're analyzing Chuck Akre from Akre Capital Management, based on their latest reported 13F filing, exploring the key holdings, portfolio concentration, and what the positioning might tell us about their thinking.
Imagine a three-legged stool. It's the simplest piece of furniture, yet Chuck Akre used it to build a $9 billion empire. But right now, that stool is wobbling. With an overall loss of 9.5% and a flurry of selling activity in his forever stocks, we have to ask, is the legendary compounding machine breaking down, or is Akre just clearing the brush for his next monster hit?
It's the ultimate test of his philosophy. We are talking about strategic pruning versus abandonment. Akre isn't leaving the building. He is just rearranging the furniture.
He lives by that three-legged stool. High-quality business moats. Management with integrity. Disciplined reinvestment. But look at the portfolio. It is down 9.5% overall. That puts the strategy under a microscope.
Specifically, he is looking at his toll bridge monopolies, MasterCard and Visa. Together, they represent nearly 30% of this $9.1 billion fund. These are the definition of an economic moat.
Yet he is trimming them. He reduced MasterCard by over 4%. He cut Visa by more than 6%. This is strategic pruning versus abandonment in real time. He isn't selling because the business failed. He is selling because of valuation gravity.
Exactly. Let's look at MasterCard through our scorecard. Moat, it is elite. It is a global payment rail. Valuation, it is heavy. The PE ratio is 33. Momentum, range bound. Technically, it is about 8% below its 52-week high of $601.77. Risk, low on business failure, but high on valuation drag if growth slows.
Visa tells a similar story. It has a PE of 30. It is sitting right in the middle of its 52-week range. Positioning-wise, it hasn't broken out.
These are Hall of Fame stocks. But even a Hall of Famer can get too expensive. When your overall portfolio is down nearly 10%, you can ignore a 30-plus PE.
He also trimmed Moody's by 8%. That's another anchor. It carries a massive 37 PE ratio.
Moody's is the ultimate gatekeeper. If you want to issue debt, you pay the toll. But at a 37 PE, the market is pricing in perfection.
This brings us back to the central thesis. Akre is trimming these anchors to fund something else. He is managing the weight of these compounders.
It is about capital discipline. Even KKR saw a small reduction of 1.5%. KKR is the contrarian play in this group. It is technically near the lower end of its 52-week range.
KKR has been a diversifier, but it also has a PE of 39. That is the highest in this core group.
This is the strategic pruning versus abandonment dilemma. Do you hold a 39 PE through a 19% loss in that specific position? Akre says you prune. You don't wait for the moat to erode.
He is clearing the path. These payment giants are the foundation. But he is making room for a massive pivot.
The stool isn't breaking. He is just making sure the legs are level. Even forever stocks need a haircut when the math stops adding up.
The stool is shaking, Mike. We are looking at an overall portfolio loss of 9.5%. Those boring compounders aren't shielding the downside anymore. It's time to talk about our primary theme, aggressive reinvestment in high-moat disruptors.
Akre is making room for growth. He is cutting into his old safety nets to fund new bets. Look at Roper Technologies. He reduced that position by nearly 20%. He sold over $400 million worth of those shares.
That's a massive liquidation. Roper Technologies is technically in a downtrend right now. It is sitting only 6% above its 52-week low. Is he just giving up on the support?
He is pruning for a reason. He is moving capital into what I call high-octane data monopolies. The biggest evidence is Fair Isaac Corp. He increased that position by a staggering 2,751%.
That is the definition of aggressive reinvestment in high-moat disruptors. He now holds over 260,000 shares of Fair Isaac Corp. It's worth over $361 million. But let's look at the scorecard for this pivot.
For Fair Isaac Corp, the moat is undeniable. They own the credit scoring standard. Valuation is the tension point. It carries a 47.9 PE ratio. Momentum is currently weak. Technically, it's in a downtrend, trading 37% below its 52-week high. Risk is high. The narrative only works if the turnaround shows real progress.
He's also doubling down on Copart. He increased that stake by 253%. Copart is another moat and reinvestment play. It's priced at $40.16 a share.
Copart is technically struggling too. It's sitting just 10% through its 52-week range. But Akre sees a longer reinvestment runway there than in legacy tech. He is betting on businesses that can price their way through any storm.
That leads us to the CoStar Group paradox. This is where the reinvestment leg of the stool gets extreme. CoStar Group has a P/E ratio of 1,097. 1,000.
It's staggering. Technically, CoStar Group is at the bottom of its range. It's only 1.5% above its 52-week low. Most investors would run from a 1,097 P/E at a downtrend. But Akre is looking at the data monopoly.
He's holding $487 million of CoStar Group despite a 38% loss on the position. This is the Akre way in action. He is showing incredible patience in the core, but decisive aggression on these new compounders.
He is shifting from steady compounders to hayacting ones. He's trading the dividend yield of Roper Technologies for the pricing power of Fair Isaac Core. He's betting that the reinvestment leg is now stronger in data analytics than in traditional software.
So, is the compounding machine breaking? I don't think so. He's just clearing the brush. He's trimming the anchors like Roper and O'Reilly to fund this 251% surge into Fair Isaac Corp.
The stool isn't breaking, it's being rebuilt. He is choosing to endure a 9.5% loss today to own the monopolies of tomorrow. It's a violent stress test of his philosophy.
Aggressive reinvestment in high-moat disruptors requires nerves of steel. Akre is proving he still has them. He's trading comfort for conviction.
That's the lesson here. When the moat is wide enough, you don't fear the valuation gravity. You buy the dip. Even if that dip is 37% deep.
The forever stocks have changed, but the three-legged stool remains the foundation. That's the Akre way. We'll see if these high-octane bets can stabilize the empire.
The math says they can. If the moats hold.
And that's the episode. We'll see you next time. Thanks for listening to Portfolio Casts.
This content is for educational purposes only and should not be considered financial or investment advice.
Any figures, prices, or portfolio values discussed are approximate, based on public filings, and used for illustrative purposes only.
The views expressed are interpretations of public information and may not reflect the investor's current positions.
Follow Portfolio Casts for more investor portfolio breakdowns.